We start today's market talk. You see the photograph. The method should gel with who I am, whether I am an investor or a trader. It should gel with your personality. The market, if you see, over the last 3 months or so, have brushed aside all negative news so far, be it elections, changes in the FNO issues, oblique taxation, or the budget, or anything else, geopolitical issues, etc. But right now, what we are seeing is a confluence of sharp escalation in Middle East, FI money moving to China, and SEBI circular on FNO trading, which all these factors can impact equity markets in terms of liquidity. And it is the liquidity which has been the one which is driving our markets. But to predict stock market direction on or any economic outlook, we need to be able to predict so many things like interest rates, consumer sentiment, business sentiment, commodity prices, inflation, exchange rates, etc. This is very difficult and messy. Hence, the only savior is margin of safety. Otherwise, you will see big drawdowns in your portfolio. Market outlook. Oil prices have moved up sharply. Stock markets have come off a bit. The US dollar has strengthened and gold prices have gone up on safe haven demand. In terms of the US, the CBOE VIX is still not at its highest level. So there is hardly any panic as such, and US economy is pretty secure in terms of the economic outlook, interest rates, and their requirement of oil, etc. So there is not that kind of a worry in US. But the worst case scenario for oil prices, global trade, and financial markets will be an escalation to the extent where Iran attempts to block the Strait of Hormuz. Now, Strait of Hormuz carries fifth, one-fifth of the world's oil. Iran said that it has concluded action after the recent firing of missiles on Israel, but the market is concerned about Israel's response. Any disruption to crude would be negative for the global economy and will result in higher inflation. SEBI announced a new FNO framework with a view to ensure market stability. So what they have done is, other than minor changes, they have made some structural changes to certain norms like reduction of weekly expiries and intraday monitoring of position limits, which will hit the stakeholders. Brokers, trading firms, and professional traders are likely to experience a revenue decline, while proprietary trading houses and high frequency traders or trading firms may need to reduce the number of trades they employ. China's stock markets are significantly undervalued compared to India's lofty equities, and foreign funds can be expected to find their way out of Indian equities and towards China's stock markets. It's already happening now. They sold off around 40,000 crore of equities in cash market last week. Now, China's measures have significantly improved sentiment. Hang Seng has appreciated by 27% in 2 weeks. Yields have gone up and yuan has also appreciated. So Indian markets may see a price or time-wise correction till enthusiasm around China's recovery subsides. Q2 FY25 earnings would be more crucial for the justification of Indian markets valuations, as it would test some pockets of stress like slowing consumption. Rural recovery confirmation from FMCG and auto sales will come from their Q2 data. GST growth in September was a mere 6.5%. So Q2 results will provide information on the demand trends. Now coming to US, US indices made weekly gains despite subdued sentiment due to escalating situation in Middle East, but a blowout jobs report on Friday gave a boost to the sentiment. Brent crude surged 9% this week. Strong non-farm payrolls report led to reduction in expectation of a 50 basis point rate cut in November. So now markets are discounting the probability of a 25 basis point rate cut in this November and in December, unless there is a change in economic data in terms of inflation or peak growth. So if you see here, US 10-year yields bounced back. Though they were in a decline, they bounced back because that is normal, because in terms of uh, global geopolitical issues, the money always moves to the safe haven assets, that is US bond. So they went up. And also because the probability of a 50 basis point rate cut reduced. So they bounced back to their 20 EMA now, which is somewhere close to around 3.97 odd. So let's see from which direction it goes up from here. US dollar index also bounced back, as dollar always strengthens in this time, and it is testing the 20 EMA, which is at 102, and it has bounced back very nicely from this support zone. It couldn't reach this level of around 100, and it has bounced back from there. Brent crude also rose. It was up around 8.71% on possibility of a disruption in supplies from Middle East. So we'll have to see this trajectory of Brent crude now. Gold, because the dollar strengthened, the gold declined a bit, but it is still resilient above the rising trend line. So we'll have to watch the subsequent geopolitical news on this. But if once the rate cuts are there, the gold is expected to go up only. Now, based on the Chinese expected recovery, copper financial futures had bounced back last week, and now they've not fallen much, but they are consolidating, and they will likely test the last all-time high. The gap which they had made while on decline has been filled. Nasdaq was up 0.13%, and it maintains that upward trend. So we'll have to see whether it is able to go above this rising trend line. It is in a rising channel and constantly making higher highs and higher lows. Similarly, with the Dow Jones, it was positive around 0.1%, and it is on a rising trajectory. So it was on a long-term rising trend line, which has got accelerated or at a higher angle now. So it is making higher highs and higher lows. So it is in a uptrend, and let's see if the uptrend continues. India VIX went up, but it has not yet reached that 16 odd level where one should be slightly worried. But it has bounced back last week based on the events in the Middle East. It had come down to below 11, and then it has bounced back. In just 4 days of trading action, in the last week, it has gone up to around 15 levels. Indian bond yields also rose up based on the US yields, and again move into the safer heavens and all. But the trend is down, so we'll have to see this. Now, Nifty, if you see here, it made a big bearish candle and took care of nearly 3 weeks of gains. So the next set of support would be the last swing low, which was at 24,800, and the last second swing low was at around 23,900. So let's see it on daily charts. If you see here, it has breached through the 50 EMA on Friday. This is a daily chart. So if you see here, it tested the 20 EMA during the day and then was sold off, and has breached the 50 EMA, and the 25,000 level is precariously poised there. The first line of support is around 24,800, and if that goes, then it will be around 23,900 or 24,000 level. The second last swing lows. Seeing it on hourly chart, made a high on 27th. That's around 26,200 plus. And then from there, it has corrected. The correction has been accelerated last week. It was oversold on hourly charts on Thursday, and then it bounced back from there. And then again on Friday after 12 o'clock, in three candles in 5 minutes time frame, it just corrected, and now it has closed at around 25,000 levels. So we'll have to see this now. Nifty Bank, again, a strong bearish candle. On 20 EMA, it is also going to test, on weekly chart, it is going to test the 20 EMA. So be careful with this. It has given up around 3,000 points of gain in a week's time frame. Seeing the weekly chart, it is weaker right now. It has decisively broken the 50 EMA and may test the 100 EMA at around 51,000 level next week in case the decline continues. But it has been taking support at around this 100 EMA level. So this should provide a crucial support. Otherwise, the next support will be at around 49,500 level. That is the 200 EMA. Hourly chart, if you see, similar decline. It made a high of around 26 on 26/27 and a decline from there. And similar, it got oversold, then bounced back, but it got sold now. So it is at crucial level. We'll have to see whether it can go up and take support or keeps declining. Now, one of the reasons for the big decline was HDFC Bank. It had risen, made a high at around 1800 level. So the people are worried that whether this was a double top. And then from there it has corrected. And now it is also below the 50 EMA. Last time it took support at around the 1630 odd levels, 1630, 1640 levels. So if this level breaches, then 2 months of gains will get decimated over just 3 to 4 sessions only. So this is a worry. The other stock which is weak is Reliance. It is below the 200 EMA and tested that support which I gave you of around 2770 on Friday. And if this one goes, then the next line of support will be around 2720, where it made a low on 4th June. So this was the distress low. So if I think this should be a decent support to get into this stock now in this area. It is on daily charts also, it is reaching the oversold levels. Now even FMCG is declining. So HUL has come and bounced from the 50 EMA. But on weekdays, it can breach this. So watch this. There is no safety in any part of the markets if the market is declining. Nifty Metals is the stronger part. It had a inverse head and shoulder pattern and then bounced back from there. So it made a fresh high. Now, if this rally can continue based on the Chinese stimulus, is one has to watch this. Last week, made a kind of a dodgy. It went up, came down, and then closed in between. So we'll have to see what happens. But this is the one sector which is in moment. It is clearly above the 20 EMA, while rest of the sectors, etc., are below 50 EMA. Midcap index, this is a weekly chart. It has come down to the levels where it was in July. So it has given up all the gains. So one has to be careful with this mid-cap also. Similarly with small caps, they're also correcting and they are reaching this 20 EMA on the weekly chart. So if it declines, then it will test this low it made on 4th June. So or the high it had made there. So once this breach, then it will be in a big negative bear market. So generally, it has been taking support on the 20 EMA line on the weekly charts. Now coming to option chain data. This is the data for Nifty for expiry on 10th October, weekly expiry on 10th October. So if you see this, these are the strike prices. This is the last traded price of the option. And this is the open interest. And these are the IVs which are indicated. So if you see here, add the money that is at 25,000 for Nifty, the total premium is very high, which is roughly 370. So if you really see from here, the saddle writers are safe till 24,650 and 25,350 from here. There is not much of the next support or the maximum put writing is at 24,500. So that should be a decent support as per the option data. And on call side, there is not much of uh, call writing in the money. So which shows that people have either closed their positions or are now waiting for a rise to short again. The call writing is at higher levels, 25,200, 25,300, 25,400, and 25,500. So these levels should provide resistances. So what will happen is, like on Friday, the rises will be used to short the market. Coming to the open interest data, so there are around 24 lakh positions on the put side and 55 lakh positions on the call side. So which indicates that the put call ratio is around 0.43, which is highly oversold, and hence because of that there is a possibility of a bounce back on Monday. Now I'll cover three stocks today. First is Indegene. It's a life sciences industry-focused digital-first commercialization company. Its solutions enable entities in the biopharmaceutical, emerging biotech, and medical devices sectors to develop products, launch them in the market, and drive sales in a more efficient and modern manner. It is something like a IT company which is providing service to the pharma sector, like other IT companies which provide service to the BFSI or the auto sector. This is also similar to that. So it should be not treated like a pharma company, but a IT company providing a service. As on first quarter FY25, it had 65 active clients, including the top 20 global pharmaceutical companies, which contributed 69% of revenue from operations. It is well positioned to ride digital adoption wave in life sciences companies. It has developed a suite of proprietary tools and platforms across the commercialization value chain to automate and create efficiencies using AI, ML, and NLP. NLP is natural language processing and advanced analytical capabilities. It has four key subsegments: enterprise commercial solutions, which is provides 55% of the revenue; enterprise medical solution providing around 28% of the revenue; omni-channel activation solution providing 12% of the revenue; and others are around 4.5% of the revenue. Now, components are enterprise commercial solution. Its components are digital content factory, campaign design and execution, web and digital portal design, patient experience data, analytics, and customer experience quotient. What it does is developing, deploying, and measuring the digital marketing operations, content creation, campaign management, technology, data analytics, and insights. So to support the business. Next is enterprise commercial solutions. It has parts like medical affairs, safety, regulatory affairs, pricing, and market access. It improves the quality of medical content, regulatory compliance, consolidate large-scale regulatory and medical operations information. Rest are omni-channel activation solutions. This is how to approach the medical representatives and promote products to healthcare professionals, and others are basically drug discovery and clinical trial operations digitally enabled patient recruitment for clinical trials, and clinical data management. Now, life sciences operations value chain segments are drug discovery and clinical trials, regulatory and medical affairs, marketing and sales, pharmacovigilance or complaints management, and manufacturing supply chain and distribution. So, life sciences operations are expected to grow at a CAGR of around 6.5% over the next few years and reach roughly 200 billion in size in calendar year 26 as a total addressable market. It has presence across the life sciences commercialization value chain. So, in terms of marketing and sales, regulatory and medical affairs, pharmacovigilance, and R&D, clinical, and others. So, it has basically provide technology, data analytics, and generative AI help for all parts of the life sciences, these industries, commercialization value chain. Now, coming to their income statement, it is expected to do, it did around 2589 or 2590 crore of revenue in FY24. It is expected to do around 3200 and 3600 in FY26 and FY27 respectively. Net profit is expected to be around 502 crore and 595 crore in FY26 and 27. So the reported EPS is expected to be around 21 rupees in FY26 and 24.7 in FY27. So it will have a PE of around 30-35 around this time. And it is growing revenue at around 14% over the next 2 years. And EPS is growing at a rate of 20 to 25% over the next 2 years. So it is growing well. It is growing better than the industry average. Hence, this stock should be on the radar. Total number of active clients have grown steadily over the years. Number of clients in the USD $10 to $25 million revenue bracket has increased from 2 to 7. The larger clients are at the same levels, and they have also kept the lower $1 to $10 million also clients at 26 level, but the total number of clients are growing now. Since it is similar to IT companies, Indegene has highest USD revenue per employee versus midcap IT peers. Midcap IT peers like Emphasis, Persistent, Coforge, LTTS, Birlasoft, FirstSource, eClerk, etc., and has highest USD EBITDA per employee versus midcap IT peers. So the major cost of any IT company is their employee cost. So if the earnings are better for them, so their margins are better. So expect a revenue growth of around 15 odd percent over the next 2-3 years in dollar terms, and a EBITDA margin of around 16 to 17% over the next 2-3 years. Seeing their chart, so see here, it was listed around July at around 500 and 520 levels. From there, it has had a steady rise and has reached that 700 plus levels, from where it has corrected in this market correction. But if you get it at around 20 EMA, that should be a decent level to accumulate this stock for a longer term, because these are stable businesses and which are not really affected by market volatility and other issues. Next stock is Adani Energy Solutions. This is the largest private transmission company operating one of the largest private discoms in India. It has historically won 30% share in transmission bids. Year to date, FY25, it has 29 operational and 10 under construction assets in its portfolio. Bidding pipeline for Indian transmission projects is healthy at 1.5 to 2 lakh crore. It's operating one of the largest regulated discoms in India, which is in Mumbai. Till date, 12 crore smart meters have been bid, and it has won 20% share or rupees 27,300 crore worth of bids. It is looking to push the envelope with its new initiative, Cooling as a Service. I'll cover it later. What is cooling as a service? It is also looking to enter into energy as a service to supply renewable energy power to commercial and industrial consumers. It raised 8,300 crore in August 24 through a QIP at a price of 970. So right now the price is below the QIP price. Uh, Operating regulatory transmission assets, uh, and from operating regulatory transmission assets to becoming a leader in competitively built transmission, it has moved along in the last 7-8 years, a long distance. Uh, and now it is moving to a leader in smart meter assets also. Uh, Among the interstate transmission assets, it has highest market share in private players. Now let's see their profit and loss. Net sales is FY26 is expected to be around 20,000 crore and it will move to around 25,000 crore in FY27. Margins are improving and will be 50 plus range in FY27, with profit of roughly 2360 crores and 3544 crore. So reasonable up move in profits, which is expected. Reported EPS would be around 18.5 in FY26 and 28 in FY27. EPS growth is around 40 to 50%, and sales growth is around 16 to 25%. So they are now in a big upward trajectory with EBITDA growth of around 36 to 40%. So the margins are improving. So if you see here, all margins are improving and the debt is reasonable. It is net debt to EBITDA is 5.6. Profitability ratios are also improving now. ROCE, ROE, ROIC, etc. Fixed asset turnover is at around 0.3. So it will improve as more and more assets are created. And receivable payable days are also now improving. Now the structure of the company, if you see, Adani Energy Solutions, it has got three verticals: transmission, where it has 32 tariff-based competitive bidding assets, 5 cost-plus assets, all it's 100% owned. Then in distribution, it has 75% stake in Adani Electricity Mumbai Limited, where sold 25% stake to Qatar Investment Authority, 100% stake in Mundra Discom and other parallel licenses, 100%. Smart metering, it has 100% stake. It has order win of 2.28 crore smart meters with contract value of 27,000 odd crores. So these are the business segments. Now, bids in transmission over the years, if you see, now the bids in transmission have increased to roughly 47,000 crore now in FY24. This is because India is looking to rebuild a new grid. So FY24, if you see, saw a huge surge in bidding for new projects. Transmission capacity needs to be built quickly in locations best suited to exploit renewable energy. Right now, the transmission grid is to the power, where the power is produced, to the thermal plants and other plants. But where the renewable energy assets are coming up, their transmission grid has to be created. Even offshore, there are a lot of offshore uh, wind energy assets which are being created. Current grid is for 400 gigawatt and requirement is for 900 gigawatt of power capacity by FY32. So there is a clear visibility for revenue over the next 5 to 6 years. Now let's see the structure of transmission business. There are central generation, independent power producers and captive. So there is an opportunity of around 3.1 lakh crore in interstate transmission, and intrastate is around 1.6. A lot of states are trying to now do this transmission thing within their state, distribution and generation. The tariff-based competitive bidding, which has been floated over the last 9 years. So if you see, the private ones are now coming closer to the power grid. In private bidders, there are only three which are there. The largest is Adani Energy. Second one is Sterlite Power. And the third one is Tata Power. Now coming to smart meters, total addressable market is roughly around 25 crore meters, out of which 12 crore have been awarded. Adani got around 2.3 crore and a cash flow of 27,000 crore. Total cash flow which was expected was around 1 lakh crore. The yet to be awarded are 13 crore meters. 6.5 crore meters are sanctioned and 6.5 crore meters are yet to be sanctioned. So there is a huge opportunity in this sector. Why everybody is interested in smart meter projects is because the IRR is 24% over the next 10 years for these projects. So, like total bid value for 1 meter is around 12,000 rupees. Total cost comes to around 5,958 rupees. They get loan of 80% at around 4,766. Upfront payment from authorities is 900 rupees. Monthly payment from authorities for the next 10 years amounts to 11,100 rupees. Operation and maintenance expenses, debt repayment. Keeping that in mind, the net cash flows over the life cycle of the product, the IRR comes to around 24%. So now if you see here, the revenue projection for FY25-27, they are expected to grow their revenue 16% CAGR over the next 2-3 years. And EBITDA is also likely to reach around 13,000 crore over FY27. So this is growing at around 40% odd rate. Now coming to cooling as a solution, what is happening is that it distributes cooling energy in the form of chilled water from a central distribution cooling plant to multiple buildings through a distribution network of insulated underground pipes. Opportunity is in commercial real estate, industrial cooling, data centers, and airport. This will come up in next 4-5 years, but this will be a key issue because it will cut down the requirement of power for cooling. Now coming to their chart, they did a QIP at 970. So it has been in this range of 1080 to around 960 over the last 4 to 5 months. It had a spike in June after election, but it corrected. Then it had a spike around the QIP time, and from there it has corrected down. So every dip is a buying opportunity here in Adani Energy Solutions if you can invest for a long time. Last stock today is Garden Reach Shipbuilders. The company's order book stands at rupees 25,200 crore, 7x of their FY24 revenue, which positions it for sustained growth in the coming 3 to 5 years. In first quarter FY25, it bagged an order worth 8,400 crore from Ministry of Earth Sciences and a 54 million contract from a German firm. The management expects 10,000 crore order inflow in first half FY25. It is set to deliver one survey vessel large and one anti-submarine shallow watercraft in the upcoming months. Several projects, P17, SPL, ASW, SWC are in peak revenue booking phase. Company is expected to achieve its peak revenue in FY26, and that is one of the reasons why the stock is corrected. Strategic partnerships are advancing with MOU with Rolls-Royce, converting into license agreement, and an MOU with Kongsberg, nearing similar transition. Kongsberg is a global provider of equipment and solutions for maritime industry based in Norway. Defense Acquisition Council has approved 10 capital acquisition proposals, including 3 for Indian Coast Guard. Navy has issued an RFP for next generation corvettes worth 36,000 crore with 2 shipyards sharing the order. Navy is also expected to release an RFP for 2 multi-purpose vessels valued rupees 12,000 crore. These opportunities position Indian shipyards, especially GRSC, to benefit significantly. Its revenue surged by 40% year-on-year in FY24, while EBITDA and PAT both surged by 57% year-on-year, which highlights the company's operational efficiency and strategic execution. 64 out of 66 ships being built for the Navy are from Indian shipyards, highlighting significant opportunities for firms like GRSC. Coming to their financials, so if you see here, from FY24, they are expected to do around 3,590 odd crores of revenue, which is going to in FY25 be around 5,060 crore and go to around 6,650 crore in FY26. This is expected to be the peak revenue, but they have an order book of around 25,000 crore, so that should not be a problem. EBITDA margins are improving. Profit after tax is improving and PAT margins are also improving, and they are expected to do an EPS of around 58 rupees in FY26 and ROE with 23%, which is stable now in 20 plus category. Now, this stock made a high in July of around 2,800, and then from there it is correcting and nearly has halved now, and is now trading below the 100 EMA. It is trading in this range now, and every dip to the 200 EMA at around 1480, 1500 is a buying opportunity for long term. Now, if you see here, there was a lot of interest and a lot of volumes in this stock till from June to July. And after that, the volumes have declined. So the days on which it makes a green candle is where the volumes are higher. Otherwise, because of low volume or low interest, the stock has been constantly declining, basically because of lack of interest or lack of any buying momentum. Now, it will take some time, but this is a long-term story. So these are one or shipyards you can have in your portfolio for long term. I have finished. We will take questions now.